Hi, Valerie Leonard here, co-founder and financial advisor of Grinkmeyer Leonard Financial. I hope everybody is doing well and having a great Easter weekend so far. So today I want to take a few minutes and talk about how you should invest your money during the COVID-19 crisis. I'm getting this question a lot, so I thought I'd go ahead and tackle it head on. But first of all, before we understand how you should invest, I think it's really important that you understand where the stock market and the economy are today. So let's back up for just a minute and let's go back to fourth quarter of 2019. The first thing you need to understand is that the economy was actually on fairly solid footing going into this crisis. We saw a lot of the economic data was actually improving. And then once the crisis actually started to hit, we saw the markets peak on February 19th, and then we started to see the trend reverse. And investors started scrambling for cash. And so what happened was you saw a lot of people and a lot of institutions selling things that they wouldn't normally sell, like conservative investments such as cash and gold and bonds, in order to come up with cash. And so typically bonds are there to help preserve people's portfolio and to help mitigate some of the volatility and the ups and downs that you can see. And a lot of times when the stock market goes down, bonds will actually rally, but that's not what happened the last few weeks. And so we had sort of an environment where most everything sold off altogether. And that was a little scary for a lot of people because they didn't understand why their conservative portfolios were actually losing money. The other thing that we've had to deal with is the oil market. We've seen a crash in oil prices as Saudi Arabia and Russia have been in the middle of a pretty brutal price war. So thankfully, this week, OPEC met and they decided to table the price war for now. And OPEC members decided to go ahead and cut production by about 10 million barrels per day through the end of April, which is a start, in my opinion, to hopefully stabilizing the oil market, but it's probably not enough. We really need to see more cuts in oil production. And so it's going to be really interesting to see how this plays out. Now, I do want to make an important distinction here because the COVID-19 crisis and even the subsequent stock market sell-off is not really the same thing as the 2008 financial crisis. And so a lot of people I've heard in the media have been making some parallels and thinking back to 2008. 2008 is fresh on our mind. So it's obviously, I think, instinctive for people to try to compare this to that event. But what I want you to understand is the 2008 financial crisis was where we had a broken system. Our banks were failing. There was a lot having to do with just the structure of our overall financial systems that didn't make sense. This COVID-19 crisis really is not the same thing in the sense that this was an outside shock to a fairly solid financial economy. And so you can't really make quite the same parallels. So if you think back to 9/11, that might be more of a more closely paralleled time in history. And what I mean by that is 9/11 was really when fear entered the marketplace. We'd just come off the heels of the dot-com crash, and so everything was already on shaky ground. We had entered a recession in 2001, and then 9/11 hit and the fear started to take hold. And then we saw the markets, crash further at that point in time. So when you're thinking about comparing this to other points in history, it's really hard to do that. Now, the U.S. consumer was also in better shape heading into this crisis than they were back in 2008. To give you an example, we've seen savings rates increase. We've seen the average consumer has had lower debt than they did back in 2008. So these are all really positive things. And then also the federal government has stepped in and they have acted very swiftly and in a huge way. And what I think you're going to see is this is going to help mitigate a lot of the damage. And ultimately, the Federal Reserve and our federal government stimulus packages that have already been put in place will probably be a very powerful influence on the market. And it's going to take some time for all the stimulus money to work its way through the system, but I think it could lead to potentially a powerful rebound. The other thing that we have to look at is business and consumer confidence. So these are very important factors because we are a consumer-driven economy. And when you and I go out and spend money, our economy actually grows. Well, right now, everybody's sitting at home. And although we've gotten a slight glimpse into business and consumer confidence numbers just recently here in the last week, we really don't know exactly how the consumer is going to feel in the next few weeks. And so this is something to pay attention to. We've got to see businesses continuing to make investments back into their companies. We've got to see consumers out spending money. We did see a lot of stimulus when everybody went out and bought toilet paper and stocked up on food, not knowing what to expect. But now we're starting to see that slow down a bit. So that's something to pay attention to. I believe we're already probably in a recession, although we don't have the economic data to confirm that. The problem with economic data is it looks backwards. And so we can't confirm exactly what environment we're in until it's after it's already happened. So I want to take just a minute and talk to you about bear markets, okay? I've got some really cool statistics here that I think will help you frame what's going on and help you maybe help your thought process when you're looking forward potentially. So a bear market can be defined as a sell-off of at least 20%. So from the peak in mid-February to the very bottom during this crisis, we've seen the S&P 500 fall roughly about 34%. Traditionally in a bear market, the average decline is about 36%. So we're right in line. And to put that in comparison to 2008, the S&P 500 was down about 52% over that time period. Now, there have been about 24 bear markets if you go all the way back to 1926 and you look throughout history, and 12 of those have been really big, significant bear markets. This COVID crisis actually has spurred the sixth worst decline, or the sixth worst bear market that we have actually seen throughout history, which is pretty significant. But on the flip side, the rally that we have seen kind of coming off the hills of the bottoms just in the last few weeks, in particular this past week, was the second best rally in all of history. So from what we can tell, this is right in line with what you would normally see in a bear market environment. Now, I want to make this distinction about bear markets because I think this is really, really important. If you go back to 1950 and you do a study of all the bear markets we have seen since then, there has only been one time where the market fell, bounced back up, and never fell again. So what I mean by that is we expect further declines in the market. Just because we've seen this relief rally in the last week doesn't mean that we won't go back down and retest the lows. Have we put a bottom in? It's hard to say. We hope so. Statistically speaking, you would guess based off of average market declines that we might be there, but we really, really don't know. I think there's still a lot of pain to come. And so what we have to understand is if we see further downside, that would be expected, okay? So in my opinion, there is more risk on the downside than there is for room for upside potential in the short run, at least. Okay, so let's switch gears for just a minute. We've been talking about bear markets, which have to do with the stock market. Now let's talk about recessions, which have to do with the economy. They're two very different things. So we know that the average recession lasts about 14 months. If you go back to 2008 and you think about the financial crisis, the recession we saw that stemmed from that lasted actually about 17 to 18 months or so. Prior to that, we saw the dot-com recession, and that lasted about 8 months. And then the recession prior to that was the Gulf War recession, which also lasted about 8 months. So we have every reason to believe in recent history, at least, that this recession could be fairly brief. And but if you look at all of history, 14 months is kind of the average. Hopefully, with the government stimulus package and the action that the Federal Reserve is taking, that will speed up the recovery time a bit. But again, nobody knows. Okay, so we've talked about where we are in the market. We've talked about bear markets and recessions. So now that we know where things stand, what is my outlook going forward? I have 7 thoughts for you that I think can help you build an investment portfolio. And they're things that you want to keep in mind when you're looking at your own investment portfolio. So first of all, number one is I expect the headlines to get scarier. Okay. I don't think that the worst is over. So when you turn on the news, just remember you're going to see a lot of negative headlines in the next few months. Number two is I don't think we've seen the peak of COVID-19 cases yet. We expect, based off of my research, to probably see that peak in the next 4 to 6 weeks. Now, when you look at the number of coronavirus cases that are out there, we're continuing to see the number of new cases rise, but the growth rate at which those number of new cases are rising has actually been slowing, which is really encouraging news. So we could see theoretically a lot of new cases, but as long as the number of new cases that are reported each day continue to decline, then that's a very, very positive thing, okay? So I just want you to keep in mind that we don't know how long this is going to last. And as we invest, we have to understand that there's risks because markets like certainty, and there is nothing certain about the current environment we're in. So number three is the data that tells us how bad things really are has yet to be released, okay? So again, I mentioned the problem with economic data is that you don't know what happened until it's already happened, right? So we expect a lot of the data that's going to be released to be pretty gruesome, to be honest with you. We expect that we'll see a lot of companies go belly up. We expect to see unemployment numbers climb, unfortunately. And if the shutdown continues beyond anybody's expectation, the worse the news will get. So number four is certain asset classes will perform better than others. Okay, so that's not really a big shock to people that are used to building investment portfolios, but there are certain areas that we believe will do well. We believe that you should diversify your investment portfolio because you never know what's going to be at the top and what's going to be at the bottom. Investors that tend to choose investments based off of historical performance, they look at their statement and they say, oh, I want to pick this investment because it performed the best last year. A lot of times that's the worst way to pick investments. So we believe in a diversified portfolio. But I think that there's some areas that are worth overweighting. So in my opinion, I think that developed economies, so international investments that primarily invest in areas that are truly developed nations, I think those are going to struggle a bit. So that's an example of an area that I would want to potentially underweight. I think small businesses or small cap stocks are going to continue to get crushed in this environment. And so I'm lightening the load on small caps right now as an example. And we know that it's impossible to time the market. So you don't want to completely eliminate your exposure to these areas, but you do potentially want to consider, are they going to be the best places that will perform going forward? We also like emerging market economies. If you think about the fact that a lot of the trade tensions have relaxed, and you think about the fact that a lot of the valuations for emerging market economies are relatively attractive right now, I think that that's a decent place to potentially overweight. But again, there's still a lot of risk in these areas. We like high yield bonds right now. So high yield bonds a lot of times trade like the stock market, even though bondholders are typically first in line to be paid back before stockholders if a company goes belly up. So we do like high yield bonds, but understand there's risk there. Bond prices have been beaten down pretty significantly as of this week. And so that's an area that we feel like for more aggressive investors could be a potential opportunity. There's certain sectors that we expect will perform better than others as well. So an example of that, we like technology. Technology we don't think is going anywhere as we work from home. Obviously, we're using technology to make our lives better. If this crisis had happened 20 years ago, we would be very lonely right now. But thanks to technology, I'm able to bring this video to you today. We're able to have Zoom meetings. We're able to continue to connect on social media and get our news in real time. So technology, I think, is going to be an important factor both for the consumer, but also primarily for businesses too, as they look to find ways to save money. Also, we think that healthcare will continue to do well. So that's an area that we like for the time being. But we like high quality brand names. We're looking for companies that have a lot of cash, that have low debt, that are in a position to be able to go out and really gobble up some of the companies that are unfortunately struggling right now. So my fifth thought on the outlook for our economy and for the stock market is that we believe the bond market is starting to stabilize. This is a very good thing, okay? The Federal Reserve has really taken an interest in buying bonds and making sure that our markets continue to function like normal. And so if we see further downside in the stock market, my hope is that bonds will act more like bonds actually should, as opposed to how they acted a few weeks back, and hopefully help people protect their portfolios. A lot of bonds are oppositely correlated to the stock market, so that means when one goes up, the other should go down in theory. And so I think that might help protect portfolios going forward. So hopefully the downside risks that we're expecting as we retest those lows can be mitigated through a really well diversified and balanced portfolio. Number 6, expect more volatility. I think it's coming. All right, that I think that just remains to be seen. We're going to see some big days. We're going to see days where the market is up significantly, and then days where the market's down significantly. That's sort of the nature of the beast in this environment. And then number 7, I believe in the innovative and entrepreneurial spirit of America. I believe that it's times like these that we come together as Americans and we create new ideas and we find new ways of doing things. And I do believe that markets will recover given some time. How much time? Nobody knows. Nobody can pick bottoms. Nobody can pick tops. So one of the best strategies right now is a strategy called dollar cost averaging, where you use a disciplined investment approach and you put money to work at regular intervals throughout time. And the idea is that you're buying more shares when the market is low, and you're buying fewer shares when the market is high, but over time, you are averaging out a nice, hopefully steady price when you're buying into this market. So it can help you avoid a lot of the emotional traps that come with investing and a lot of the pitfalls and mistakes that a lot of investors make. So if you would like some more thoughts on your specific investment portfolio, feel free to reach out to me. You can give me a call. You can send me an email. You can schedule a time to talk with me one-on-one. I would love to give you some advice. And I hope that you have a great Easter weekend, and I look forward to connecting with you.